In the world of business, cash is king, but knowing how much cash you have isn't enough. You need to understand your liquidity. Liquidity is your company's ability to meet its short-term obligations. Without it, even a profitable business can fail. Today, we're going to master the art of measuring liquidity using standardized short-term financial metrics and current assets. So, what exactly are current assets? These are the short-term economic resources your business owns. Technically, they are assets expected to be converted into cash, sold, or consumed within 1 year or one operating cycle. The most liquid current asset is cash and equivalents. This includes checking balances, treasury bills, and money market funds. Next is accounts receivable, the money owed to your business by customers who have made credit purchases. Then we have inventory, which encompasses everything from raw materials and work in progress to finished goods ready for sale. Prepaid expenses are advance payments you've made for things like insurance, rent, or professional licenses. Finally, short-term investments are marketable securities that you plan to liquidate within the next 12 months. Now that we know what current assets are, let's look at the 3 core ratios used to evaluate them. The current ratio is the most general measure. It divides your total current assets by your total current liabilities. A healthy target for the current ratio is typically between 1.5 and 2.5. The quick ratio, or acid test, is more stringent. It excludes inventory and prepaids to focus on more immediate assets. For the quick ratio, you want to see a value of 1.0 or higher to ensure you can cover bills without selling stock. The cash ratio is the most conservative measure. It only considers cash and short-term investments against your liabilities. This ratio is a pure test of immediate solvency, showing if you could pay all short-term debts instantly if needed. Let's look at the mathematical architecture that connects these ratios and assets together. Total current assets is the sum of cash, receivables, inventory, prepaid expenses, and short-term investments. Your quick assets are just the cash, short-term investments, and receivables, the ones that turn into cash fast. And your cash assets are strictly the most liquid pieces, your cash on hand and your short-term investments. Understanding these numbers allows us to map out risk profiles along a liquidity spectrum. If your current ratio drops below 1.0, you are in the insolvency danger zone with high default risk. A high current ratio but a low quick ratio suggests you are overly reliant on inventory, with capital trapped in slow-moving stock. A direct cash shortage occurs when you have high quick ratios but low cash ratios, meaning you depend heavily on collecting receivables. On the other end, a current ratio over 3.0 might signal capital inefficiency, too much idle cash that could be reinvested. The goal is the optimal balance, a healthy, stable liquidity position that supports both safety and growth. It's important to remember that healthy varies by industry. What's safe for a grocery store might be risky for a manufacturer. Retail groceries often operate at low ratios because of rapid inventory turnover and constant cash sales. Enterprise SaaS companies, however, tend to have much higher ratios due to negligible inventory and upfront revenue. Manufacturers need a larger cushion, ratios around 2.0, to manage long production cycles and high overhead. Public utilities can safely operate with lower ratios because they have very stable regulated cash inflows. Let's look at 2 case studies. First, Peak Scale Software, which maintains an excellent liquidity position. With a current ratio of 1.75 and a cash ratio of 1.0, they cover all liabilities without any inventory. Now contrast that with Urban Fabricators. On the surface, their 2.13 current ratio looks strong, but their quick ratio is only 0.56. They are heavily dependent on selling inventory to pay their bills. So how can you optimize your own liquidity? Start by focusing on your cash conversion cycle. Minimize the time between purchasing materials and collecting cash from customers to keep money flowing. You can also reduce your days sales outstanding by offering early payment discounts and following up on overdue invoices. Improve your inventory turnover by using JIT or EOQ models to align your stock levels more closely with demand. Finally, try to negotiate better terms with suppliers. Extending your DPO helps keep cash in the business longer. Remember the key takeaways. Liquidity is not solvency. Always use all 3 ratios and remember that context is everything. This tool provides structural estimates only. Always consult a licensed CPA before making major capital decisions. Thanks for watching our guide to mastering liquidity. Now you have the tools to evaluate and improve your financial health.